All right, welcome everybody to our Wednesday webinar tonight. We have a treat where Bill is back with us presenting. It's always, I call it a fan favorite when Bill's here. I always refer to Bill as the only accountant that speaks English to me. I actually understand what he says, makes things very simple. So tonight, you want to make sure that you have a really good plan to end the year. Remember, it's not how much you make, it's how much you keep. So tonight we're going to talk about that as an educational series. Even though we do have a professional in the room, he is not providing you tax advice. He is not your accountant. He might be at some point, but currently. And so we're providing education that we believe that you need to use to guide your own financial decisions. And then you would do that in conjunction with your financial professionals that you're using. Everybody's situation is different. So that's like the sign says, it's theirs. I love that. So
I had a good laugh at it.
it's there. So understanding your tax bracket, understanding the flow of money. We're going to talk about a current deal where there's an opportunity for some depreciation that might help you offset your taxes. And at the end, we will have time for a Q&A. When you do your taxes and expecting a refund and find out you owe money. Who's been there? Raise your hand if you've got your camera on. Who's been there, right? All of a sudden you thought, oh, what? I owe? Oh, where am I going to get that money from? And that's how many people spend their life, especially if you've got a lot of diversification with income coming in and different investments. So you really want to make sure that you understand where your money is going and what you owe and how you can reduce what you owe. So love
Thank
him or
you.
hate him, he said, I pay no taxes. Those that love him are happy today. And why does he pay no taxes? It's the power of real estate investing, the power of using tax derivatives. One thing I learned that was really fascinating about the Donald, why he buys all the golf courses? Because he can take all of the swampland around the golf courses, donate that as preservation, and he gets a 10 times tax credit. Think about that. Swampland, 10 times tax credit. That's tax planning.
Hey, so we'll talk about it right now, right? So here we are. Okay, Trevor, so I can take it from here.
Yep.
That's okay. Cool, awesome. Now, before we go, full disclaimer: if you own properties, this is one of the worst times of the year because you got to cut a big fat check to the federal government or state government or city for your property tax. So our heart is with you, right? This is the worst time of the year that you got to pay some property taxes as you go. All right. So what we're gonna cover tonight? We have a little bit of a sequential methodology. So it's not two. We'll talk about more than two or three. So first is understanding the investment portfolio, which is a buildup from last webinar that we have done. Then we'll get into the increased income, and we'll talk about some of the decreased costs, and then income and tax optimization techniques. And then number 5, we'll have 2 different types of investments in front of us, so we can role play and talk through it. That hey, if I'm an investor, and how would I deploy my capital to optimize my income for this particular year? So from your perspective, keep on asking questions that how can we optimize our income tax for this particular year, given we have less than 2 months minus the vacation and holidays. We really have about a month to make a choice, right? So on the right, hey, write-offs are good, but not everything can be written up, and all write-offs has a limitation, right? How much can we write off? So it's beyond the Instagram and your TikTok. There's not that much. You have to really look at the revenue and the costs and write-offs, and then legal structure, and then optimize it. Okay, so investing in CRE, building your portfolio. So last week we talked a little bit about the risks associated with the market and the investment that we have. And as passive investors, or as an investor, how do we de-risk our portfolio as much as we can? And we talked about a couple of things. On the top left, all of us, we should have a strategy or an investment hypothesis, asking the question, what are we solving for from our investment? Right? Just like buying a stock. When we buy, we have dividend stocks, we have growth stocks, we have some crazy option stocks, and we have Bitcoins, right? crazy on top of the crazy. So similar to that, we also have real estate. You can ask the same question that, hey, should I spend some of my money in the single family BTR bucket? Then I can offset that with the flex space or industrial triple net bucket. So cash flow, steady state, fixed income, behaves like your dividend paying stock. And do I deploy some of the money on the land development that behaves like a CD-ish, very low downside, but upside is there. If it works out, worst case scenario, I'm protecting my downside. And then we do some new construction because I want to get my return a little bit faster than 5 years. And then lastly is my tax optimization. Do I do industrial or multifamily? So I get cash flow plus an appreciation, and you get depreciation, right? So all of those things you need to keep in mind. So ultimately, it's going to boil down to two things. Either you be an actively passive. So we don't, nothing is purely passive, right? Even though you're passively investing, in a sense, you are active because you're here. You got to study, you got to read the OMs, you have to go understand the PowerPoint, you have to go to the webinar and all those things. So we call it, we have two things. One, be actively passive or be really active, right? Like us. We are really sponsoring and leading and hunting the deals, running the deals, and then delivering the promise to our investors, right? So at the end, I'll bring this slide back so we can ask the question, okay, what does it feel like to be inactive? What does it feel like to be passive? And we always say, take the first step. If you don't know, that's perfectly fine, but step forward and then get another data point, and then you can decide which way to go. And faster you get there, faster you're going to know what to do, what not to do. And we always call it like as you get into the process, figure out at least what you don't want to do. That's half of the game, right? And then we can continuously move forward. All right, so let's take a look at it. Again, this is purely for educational purposes. This is for fictitious number. I changed the numbers again. Then we're just gonna go through it. As I go through it, we have Bill. Bill, I will bring you in as you kind of get into the conversation so we can go. So the first thing I will mention, the build your portfolio, so have an idea. Second thing is understand your income. So I'll give you an example, like a real example with some sort of a number difference, that how as we earn more, what happens in the middle, which is how much costs, and as we design the cost structure, what happens to our net income, right? So this is an example of a married couple. On the top, married filing jointly. The tax bracket was 24% in year 2022. Their income, they have a business, that their income was about $308,000, because one from the couple, someone has a W-2 and someone has a business, right? Put together, their household income was a little over $300,000. They didn't have much of a deductible, so adjustable gross income was around $300,000. Their tax was only $48,000. That's because their taxable income and also that they had some credit. So either way, so the deductions brought down the taxable income, and then at the end of the day, their total tax that they owed was $48,000, and they had some penalties. And at the end of the day, they kept $300,000. So they earned $308,000. They kept roughly $300,000, right? So they kept 98% of their earning. Same couple, move forward to year 23. Their W-2, maybe some bonus included, they stayed the same, but the business doubled. So inherently, their income went up by 187%, from $300,000 to almost $600,000. That by design, the gross income also doubled. I mean, 186%, right? But then their tax burden went up by 300%. They had some design, though Bill is going to come talk about it. But here in 2023, they didn't have much going on. So in a sense, their taxable income went up. Their depreciation wasn't available. So at the standard process that they followed, all of a sudden, the income tax went up to $153,000. So at the end, look at the very bottom line. They took $423,000. So even though they earned 186%, they took home only 141%. They left 26% on the table. And that's a six-figure check that they left on the table because the depreciation or some of those taxation purposes wasn't there, right? So that's one. So Bill, I'll need your help a little bit more on that one. So from our perspective, we always push the income first. Then different income level may require different income tax optimization because everything costs money, and we need to think long term. Sometime we'll pay the penalty today to get ready for be in a good position next year or year after. And then last thing, remember that whatever says not only how much you make, set by the title, but also how much you keep, right? So on that one, Bill, what
Yeah.
would you say stands out 2022 and 2023? And if that couple, what would you recommend them to do this year?
Yeah. So the biggest thing that you kind of look and you can kind of tell, like, so if you start on the top line where it says the tax bracket, 24% or 35%, what that means is as you make more, the government takes more. So they take it's not that all of their income was taxed at 35%, but what happens as you go through different brackets. Imagine you've got buckets and you're filling water into different buckets. Once you're full with one bucket, you move on to the next one. Then you move on to the next one. But the difference is the first bucket you poured in, maybe it only cost you 10 cents per gallon to fill that one up. But then the next one's going to cost you 25 cents and then 30 cents and 35 cents. So it's still the same water. It's just costing you more as you go higher. So what you're basically doing is if you come down to your total tax, so like the 48,000, effectively that's about 15.76%. Like, so of the income, while they're in the 24% bracket, because they had deductions, because they had credits, you're paying about 15% overall. But now you go forward to the next one, they're paying like 26%, 27%. It's because as they make more, they're paying more. On top of that, you'll see there was something up there called the qualified business income deduction. That's gone. And the reason for that is not only is it you make more, you take more, as in more, they take more in taxes, they also take away some of your deductions. And so if you don't craft your business correctly, you could be leaving money on the table. Now, what that qualified business income is, many people call it the Trump tax cut. I call it the 20% coupon. You're taking your business, so like your Schedule C business, and you're getting up to 20% of that as like a coupon, take off the taxes. But they give limitations. Some of it is as the income goes higher. Some of it is also based on if you have payroll or if you have real estate, some of it's based on the assets you own. So what we might have done here is kind of looked at that Schedule C information where it says business income or loss. We went from 237 to 446. Well, maybe there's a different type of business structure. A lot of times people will say they're an LLC, but they don't realize an LLC could be self-employed, could be a partnership, could be an S corporation, could be a C corporation. Sometimes by just changing up how you report your income, you may actually be able to lower your income for the same cash flow. And by lowering your income, you're going to lower the taxes you pay, which actually at the end of the day, that actually is going to increase your cash flow. Because the IRS, they're not taxing you on cash flow, they're taxing you on your income. And so it's how you report the income. And then again, even on top of that, this isn't really so much in here, but a little bit like that Schedule D, capital gain, capital loss. Not all income is created equal. Now, all that being said, we might take a step back to how does this all relate to real estate? This doesn't show it, but it's possible we put one of the people in the couples, like, so this was a married couple, could be the husband, could be the wife, or okay, could be spouse number one, could be spouse number two. We're able to make one of them not only a real estate professional, but a real estate professional with active participation. Short version, a lead investor or a landlord. You have to be able to like be managing your properties. But now once you do that and you're invested in some of these other deals with this depreciation, you might see massive deductions coming to offset your income, bring your income down, bring you into a lower bracket, bring you back some of those credits, some of those deductions that then just accelerate the cash flow in your pocket. Now, being the real estate professional, that's not the same thing as saying it's tax-free income. You're getting cash flow. That's not the same thing as saying tax-free. It's just more tax smart. It's tax deferred, because we're going to front load our expenses and then we'll let tomorrow take care of tomorrow. It's not that we ignore it. We're going to go into it with eyes wide open. But oftentimes with real estate, we say defer, 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 die. And that's because in many community property states, actually all community property states, many states in the US, spouses don't inherit a tax debt. When they inherit something from the other spouse, it's unlimited. They don't get the debt when it's outside of their IRA. Now, passing it on to kids, currently your estate, there's 25 million. But even then, it's kind of a nice way. We get to take this depreciation. And if someone dies, which, okay, 1 out of every 1 people die. So newsflash, everyone on this call is going to die one day, even me. But whoever inherits it after you, they get to hit the reset button and start the depreciation all over again. So we could extend this out to many years and go, okay, yeah, in the year 2064, they died, and see how it shows again. But it's just one of those things. It does work the same way with stocks. Just FYI, if you buy stock Tesla for $5 and then like today it goes up to 500, when someone inherits it, they do get it at the new value. The difference is they didn't get any deductions when they own the stock. When you own the real estate, you're getting deductions to offset your income, and then you get to reset it. So long story a little bit longer is, as we look at this would have been a great opportunity to plan before the end of the year hit. So kind of like right now, we've got about 7 weeks left. If this looks like your situation, we probably want to talk. Sometimes there's nothing you can do. Sometimes some deductions, it's not that the IRS is saying not never. They just might say like not now. So like for the passive investor, which includes me, I'm passively invested in a lot of deals. So if there was a way to deduct it, I would have figured it out, or I probably would have. I'm building up a lot of my passive losses. It's not that I'm never going to get the deduction. I'm just not taking them now. And then when my deals start selling, I've got a big pot of gold at the end of the rainbow, because all those deals, them gains, I'm not going to have to worry about taxes when they sell. I get to keep deferring. And then I'll probably die first, so my wife will live tax-free.
That's good. So, Bill, thank you. So the biggest takeaway here is that go look at your last year tax filing on the page number 2 or page number 1. Your CPA will going to give you a whole stack of docs. Page number 2, I think, it's going to give you a version of this 2022 and 2023, and then take that and put on an Excel file and do it 2024. Good, bad, we just don't know, but this is the last push that you have. So the point that you go find your CPA. Again, when you talk to your CPA or your tax strategies, typically don't call the guy or girl, or we love them, but who charged you $500, $600 to do your tax filing. That's not their role in that sense. They're not tax strategies. They're more of a form filler, right? So their job is to get you that numbers in, but not optimizing. So ask them for referral or talk to someone.